In today's halftime overtime, yields of dreams. The recent rise in interest rates has left nearly 85% of stocks in the S&P 500 yielding less than the two-year Treasury. But despite this newfound competition from bonds, Joe Terranova is still finding attractive opportunities in dividend stocks.
Both personally, I own, and in the Joe T ETF, Blackstone, AbbVie, and Merck. These are three names, strong dividend yields, reasonable valuation, mid-teens. So these are three instances where I think you could look away from the competition in a two-year, right, that you're getting from bonds and say, okay, I'll own these companies.
All right, joining us now, Douglas C. Lane managing partner, Sarat Sethi. Sarat, I thought yields up, dividend stocks go down, no?
Not all the time. I mean, Joe T's right there. I think you're going to look at stocks that also increase dividends over time. So, for example, Merck does, to his point, but, stocks like we like J&J, J&J's increased his dividend over 30% in the last 5 years. Now, that's ahead of inflation. Same with Coca-Cola. Those companies that have pricing power, you want them to raise their dividends in line, if not ahead of inflation. Those companies that are just holding dividends straight, some of kind of the utilities and some of the telecom, those are the ones that are going to get hit hard, because that's where people will move the assets away from common equities into bonds, because you can get that steady dividend on the bond side.
Do you think it's harder to sell investors on a strategy of dividends, though, in this current environment? We read you one of the stats, fewer than 16% of the S&P yielding greater than the two-year. It's fewer than 20% yielding greater than the 10-year. That, according to Strategas. Is it a harder sell as a money manager with clients who are looking for some, level of safety, if you want to put it there?
It is a harder sell because equities have volatility, and people have seen, especially through COVID, those stocks that had dividends actually went down worse than the market. But I think a good combination of good dividend-producing stocks that are dividend growers, I call them growth and income, along with now you can buy bonds. And you are going to get, and you've seen it, you're getting 4.5–5% yields on corporate bonds that are 3 to 5 years out. We haven't seen that, Scott, in over 5 years. So I think it's a combination, but it is definitely a harder sell, especially for those investors who are scared of volatility. And dividend stocks have been volatile just as much as the rest of the market.
Hey, Sarat, before I let you run, I'm looking at this news on Ford that crossed a little while ago, and we could throw the stock up in overtime because it was taking a pretty good hit. They say the effect of parts shortages on their third quarter performance is going to be a little more dramatic than they expected. They did reaffirm their full-year adjusted EBIT guidance, but nonetheless, they say inflation-related supplier costs during the third quarter will run about $1 billion higher than originally expected. If Ford is saying that, wouldn't you imagine that GM would have some of the same issues?
I do. I don't think this is going to be isolated. I think you're going to see this through the auto supplies. But you also saw it last week. GE said the same thing. So I think you're coming into an earnings season, which we've been expecting, where companies are going to start talking down, maybe kitchen sinking it, saying, hey, we have higher costs. Supply chains are really hard. We're not getting the products we need. Even though, shipping times are shorter, it's just the products aren't there with semiconductors, other things. So we're going to see it. Good thing that they actually kept their earnings guidance. But the question, Scott, what is going to be next year, right? If you're going to keep it this year, are you pulling in from next year just to keep this year? And I think the market's probably going to speak and say, hey, we don't believe you. Because you've also got a demand issue going on, right? At what point does the consumer say it's too high to finance, or I have enough what I need, and it's a slowdown? So I think this is something indicative of what we're going to see in the next 3 to 4 weeks of earnings season.
All right, I appreciate it. Appreciate your help on the dividend story and on this news, which is moving and causing Ford shares to decline by about 6% in overtime. Sarat Sethi, thank you very much.